What's benchmarking? Benchmarking uses reference points. That's like we normally say, use a reference point to compare performance with other appropriate entities. The comparison typically is with those that apply leading or best practice, and the objective is to identify and implement actions to improve our performance. It is an important tool in performance improvement and quality management. It helps organizations with productivity management and business process reviews. Again, use the reference points to compare to the leading practices and best practices and identify and implement actions to improve performance. All right. Benchmarking also similar to, but not the same as performance indicator. Benchmarks are compared with performance of others, but KPI are compared with targets set by the management. So normally that's what we say. Of course, someone can argue that we're benchmark against ourselves, like what we did last year. That's fine, but typically when we say benchmark, we're using benchmark to refer to the comparison against others. Benchmarking may also have been used to help management to determine the targets for a particular KPI, like say, okay, our competitors achieved this profitability and we want to beat them by 10%. So that's how benchmarking can help us to determine the targets for a particular KPI. What are the typical benchmark examples? Well, like day to sales, how long does it take a accounting department to close their book? All right, so that's can be used as a benchmark. Customer satisfaction percentage. All right. So for every million products we produce, what's the defect rate? How many dollars of sales per salesperson, for example? And how many days from customer order to finally the customer received? So those are the kind of operational measurement. All right. So that's, and benchmark can have, okay, internal benchmarks. So we compare performance across different parts of the businesses. The potential weaknesses, or what's our potential weaknesses? What's the strong performance? But if the strong performance may not be relative to comparable sometimes. For example, a store in retail chain may be compared with each other using a range of metrics to identify strong and weak performance. This will offer us insights by understanding the reasons for superior performer versus the reasons of the lagging performers. Potential weaknesses of internal benchmarking is that the strong performer may not be relative. Again, like for example, in my company I used to work, one of our star performer in sales, it happened to be in one of the best region in terms of economic activities. So naturally, that particular region, because of traditionally have a very economically vibrant region, so that person has a higher sales performance is not a surprise. So if you compare that to another region that typically are new territory just been recently opened to our company's product, and that's apple to orange comparisons. So that's not easy. That's what that says. Okay, and then the entity could be outside organizations. All right, may not be at that. So just like outside organizations, the same thing. All right. Opportunities for significant improvement may not be identified. So I'm missing identified here. if you only compare it to the internal benchmark. Okay. Just sorry. For the external benchmarking, obviously, as we normally refer to, is compared to our competitors within the same industry. That's called competitive benchmarking. Sometimes we have another external benchmarking is called genetic benchmarking. Is similar processes in different industries, so may result in greater collaboration or mutual benefit. For example, we can compare telecommunication like AT&T's against Verizon, so that's competitive benchmarking. But also we can compare AT&T's customer service against Bank of America's customer service call center. So that's genetic benchmarking across different industries, but still pretty helpful to each other because they're not competing in the same sector. So they can help each other out by benchmarking against each other in terms of call centers, efficiency, productivity, customer satisfaction, so on and so forth. All right. So you can benchmark on the processes, you can benchmark on the outcome, which is performance, and you can also benchmark some strategic planning and the priorities. All right. The second topic here is value-based management. So what is the value-based management? It's response to the limitation of accounting information. So accounting information is more financial-based, profit-based metrics. So maximizing profit. But when we study balanced scorecard, we understand most of financial metrics are lagging indicators of companies' performance. Is after the fact. Well, creating value needs proactive processes in place. So we need a matrix that measures those that can actually generate values, not after the fact. So profit-based metrics does not address all those leading factors. It ignores returns by providers of capital, so on and so forth. Okay, ignore return required by investors. And GAAP also is more of a accounting for expenditures as expenses rather than, for example, the R&Ds, which is a value creating, but per GAAP, those R&D spendings are expensed into current year financial data, which could become a drag on the income for that particular year, but actually has a long-term benefit going forward. So if we only focus on GAAP metrics, then the management has a potential to withholding the R&D or not investing R&D to the detrimental of long-term growth, but for the short-term benefit of improved net income number for that particular year. Right? So we want to using value-based management rather than purely focus on accounting-based metrics. ROI we studied before, like one of the assets efficiency measure is a return on investment. And that's basically net income divided by the investment. So that's an accounting-based metrics. Is that reliable? I know we want return on investment. Is that a reliable value generation metric? No, it's not. Not always. One could potentially reject a value creation project because it decreases ROI. For example, if you have, like in this particular example, if you have currently you're running an ROI of 12%, but there's another project coming up. It's going to generate positive income after you're deducting the cost of capital. So if you cost capital is 10%, but you borrow that cost 10% interest, but you're able to generate a return of 15%. So there's an increment of 5%, which benefits the company, benefits the shareholders, ultimately gives shareholder more money back. But if that's only like 10% ROI, I'm sorry, some math may not work, but the point is, even if that project is generating positive returns, but if it's less than the current existing ROI, then if we only focus on ROI, then the manager say, oh, I don't want to invest in that particular project because if I do, then I will lower my overall ROI, which make me looks bad. So therefore, I'm going to rejecting that particular project. But when in fact, he or she should have accept that project because it has a positive residual income and economic value added to returns. So because ultimately we're interested in total monetary returns. We love high percentage returns, but the bottom line is we will receive more absolute amount of returns. That's more important. All right. So ROI by itself is not reliable value generation measures. So what is the economic value added? That's what I earlier just mentioned. Well, it is a financial performance metrics that calculates the value, and it measures the true economic profit. So why is it important? Because it's true profit management. All right, and it helps us assess management performance by determining if they are generating returns above the cost of capital. That's creating values. And then it helps us to select the better investment projects. Okay. And then it allows us to allocate our cost to the project that generates most of the returns after the cost, after deduction of cost of capital. Okay. So how is it calculated? Or is after tax, net after tax operating income, we'll call it NOPAT, NOPAT, minus the invested capital times weighted average cost of capital. We'll talk about how to calculate weighted average cost of capital in the future. Look at how is it different from the residual income. Residual income is operating income minus the targeted returns on invested capital. So the targeted return is different from weighted average cost of return. Weighted average cost of return is the actual costs of the capital. A targeted return is expected return on the capital that you're going to invest it. So that's the difference, okay? So how they're different? Well, they're calculated differently. All right. And the focus are different. And their usage, they use it for different purpose. All right. Again, you can refer back to the digital book to get more details, but it's relatively, again, straightforward section.